All right, so let's talk about ranges. Let's talk about premium discount. We're going to be using our Fibonacci during this to really get a good understanding of these ranges. So let's start here. All right, so we're on a 15-minute time frame on NQ. Every swing high, swing low, that's a dealing range. Okay, so from this swing high here to this swing low, that's a range. Okay, so let's look at that range first. So what do we do when we see a range like this? Well, we're ranging down, or we're moving down, right? So our structure is bearish, bearish, bearish. We're creating lower lows, lower highs. Okay, so when we see a range like this created and we start to see some pullback in the market, right, or we're retracing in the market, now we have to look at each range. Okay, so we're going to use our Fibonacci. I'm going to change the settings. I'm just going to keep the 0.5 on here. Okay, we're just going to look at the 0.5. All right, so there's that 0.5 right here. Okay, so that's our 0.5 level. Make that red. That's our equilibrium of this 15-minute range. So why does that matter? Because above this area is our premium of this range. This is the premium. Everything above the equilibrium and everything below is our discount. So everything below is our discount. Okay, so when we form a swing high, we form a swing low. Now what are we looking for is we're looking for retracement in that range back up to a premium to be able to sell. You typically don't want to look to sell when you're in a discount, or you don't want to look to buy in a premium. The only time I'll look to sell is if we break out of that range and then we retrace, right? So I'm not really looking to sell in the discount here. I'm looking to sell once we get back to a premium. So we use our Fibonacci from this low to this high. There's that 0.5 level. We see we retrace into a premium. So now what are we looking for in the premium is we're looking for a PD array, right? So let's just say we're using this 15-minute order block as an example. Look at that 15-minute order block. We had a displacement candle. We retrace into it, and notice how we use that as resistance and head back down. Okay, so we head back down. We displace this range, and then you can see here, this is the middle of the night, so we don't see a lot of movement. But that's that idea. So any range you look at, you're looking at the premium, you're looking at the discount. Okay, so the premium is the top 50%. The discount is the bottom 50%. So you can go back and look at different ranges that we create, you know, until like here we saw that a little bit of a reversal. Okay, but let's go back and see if we can find another example of this. So it's not always going to be where we're always going to retrace back into a premium, or we're going to retrace back into a discount, but it's a really good basis to look at. This will help a lot of the time to understand why price is retracing up to this area. Well, on this range, we're just looking to get a better price to sell up here, right? So we're always looking to sell in a premium, buy in a discount. Okay, so let's look at a different range here. We could even look at this range here on the 15-minute. Okay, so we go from this low right here. So let's look from that low up to this high. So this is another range here. Okay, let's use our Fibonacci from this low to this high. Okay, look at, so above here, that's our premium of this range. Below is the discount. Notice how we trade back up into a premium. Again, using another order block as support or as resistance here. Boom, trade up into that order block, and then we drop. And then we displace this range, we create another range, right? We trade up into a premium, we come down, we displace this range. Okay, so that's what you're looking at on these long-term, or just on these swing highs and swing lows. Yes, I am recording it. So you're looking at these swing highs and swing lows. If your bias is bearish, then you're expecting these ranges to be created, and then you're expecting price to take out our previous low. So notice how we take out this low. We form a new swing low, a lower low. We come back up into a premium, use a resistance level, come back down, make a lower low, create a new range, trade back up into a premium, come back down, create a lower low down here, right? And then we can look at this range as well. So let me delete these real quick. Okay, so now let's look at this swing high, right? So this is our new swing high that we've created, a lower high. Okay. And then we come down and we form a swing low down here. Let's see if we retrace again back up to that 50%. Back up into a premium of this range. We do. Look at that. We trade back up into a premium. Let's see if we respect this resistance level here at this 15-minute order block. Boom. Again, that's 3 in a row right there of this bearish trend. Okay, so we start up here. I mean, even up here we have it too. From this swing high to this swing low. We trace into a premium. Another swing high, swing low created. Retrace into a premium. Another range created here. Swing low, retrace into a premium. Another range created here. Retrace into a premium. Another range created here. And then ultimately we finally see us trade, you know, kind of back up and then create a higher high. So that's when our market shifts, right? Our market shifts once we create that higher high up here. To now we're not looking as bearish anymore. But again, this is what we're looking for. This is that premium, that discount. So anything above the equilibrium, above that 50%, is going to be that premium. Anything below is going to be that discount. All right, so that's what we're looking at. It's not super complicated, but it's something that's really good to be keeping an eye on, and it can be any types of any time frame. It does not have to just specifically be on the 15-minute. You could look at it on an hourly, on a 4-hour, all these different time frames, right? We could go back and look at it on an hourly time frame. Let's remove our drawings real quick. Let's see. Okay, so we create up here on the hourly, we create a swing high, we create a swing low. Okay, now we use our Fibonacci. From that high to that low, look how we trade up into a premium, and notice what's right here, and the premium is an hourly fair value gap. We trade into that fair value gap, and we drop. Okay, then we create another range here from this swing high to this swing low. You can see we don't even need to use our fib. We trade up into a premium, and then we drop. Then we create another swing high up here, another swing low. We trade into a premium, into this hourly fair value gap here. We drop, right? So you can look at it on an hourly. It's as long as we're going with the trend, right? As long as we're understanding our bearish or our bullish trend, that's when you can really use the premium and discount idea. So if you know that we're trending down, you know that we're trending bearish, every time we see that retracement in the market, we're expecting it to come back up to at least a premium, find a PD array like a fair value gap or an order block up here, and catch it back down, right? So we could look at it for the longs as well, right? So we're looking at an hourly time frame on the longs. It's kind of hard when we go into like the middle of the night, right, when it starts getting a little bit choppy and stuff. But let's see when these longs, you know, the longs start. Let's just say all the way down here, right? So this is when we see that reversal, trending down, trending down. Okay, now we see this reversal in the market. We're looking to head up. Okay, so we come down here, swing low, swing high. Use our fib from the swing low to the swing high. Price trades down into a discount. We also have this fair value gap. We trade down into a discount just barely, push up, make a new swing low, and a new swing high all the way up here, right? So this is kind of that new swing high up here to the swing low. So we use our fib again from the swing high to the swing low. We trade all the way down back to the bottom of that range, but we don't create a lower low. We don't create a lower low. We still create a higher low. Okay, so even though we trade all the way to the bottom of that discount, it's still considered, it's still not a market structure shift or a break of structure all the way, you know, we would have to take out that low. Okay, so what do? We trade into a discount, we trade back up into a premium, we create another high. Okay, so we use our fib again from this high, swing high to the swing low. So here, you notice we don't trade all the way back down into a discount. So we're not always going to trade back down into a discount. Sometimes we're just going to use that gap, but I wouldn't necessarily be looking to long right here if I was looking at an hourly time frame, I would pretty much be wanting to wait for us to go back down to a discount. Just depends on if it was a news event, like this right here, I'm pretty sure was an earnings report. We saw that crazy pump, and we saw that continuation back. Okay, so then we create a higher low, higher high, and then we start to see a market structure shift back down, and then we come back up, right? So it's just reading those ranges from the swing highs to the swing lows, waiting for retracement back into a discount or back into a premium, and remembering that it's not always going to happen perfectly, but it's good to keep our eye on. So like look at this today, and this is from yesterday. So we have this swing low down here, we have this swing high up here. Okay, let's use our fib from this swing high up top. Notice how we traded back down into a discount, into right here, into this fair value gap balanced price range, and then we're seeing that pump. So what we would need to see is another high created up here to confirm our bullish bias is going to continue, back up to these highs again. We would need to see another high formed up top, taking out this swing high. But notice that we form another swing low here, and we formed kind of a swing high here, which you don't want to see this necessarily. You want to see us create a higher high up here. But let's say you're looking at this range from this swing high to that swing low right there. Okay, we traded back down into a discount, and now we're pumping. Okay, so as long as you're going with that trend, you're gonna see how often we do this type of thing, where we do this retracement back down into a discount or back up into a premium. It happens very often. So that's kind of what we're looking at. And again, you can look at any time frame. It does not just have to be the 15 or the hourly. You can look at it on a daily time frame as well. Right? You're looking for swing highs to swing lows. You're looking for that retracement back down into a discount, up into a premium. And you're going to see this happen on all time frames. So that's kind of what I'm looking at there. Do you guys have any questions or comments for me about our premium and discount, about these ranges? Was that helpful?